Good morning, everyone. Today I want to talk about something that has caused more lending businesses to fail than bad debt, competition, technology, or even regulations. And that is cash flow. Many business owners focus on profit, and profit is important, but profit and cash flow are definitely not the same thing. In fact, a lender can be highly profitable and still run out of money. Let me explain. Imagine you have 500,000 Rand available for lending. You deploy all 500,000 Rand into loans. Those loans are profitable. Customers are paying interest. And on paper, everything looks fantastic. But then an opportunity arises. A good customer needs a loan, or a large client needs funding. You maybe need to pay salaries. You need to pay rent, or you need to pay for your software subscriptions. You need to pay for compliance costs, and there's a whole bunch of other things that you may need to be paying for. And suddenly you discover something important. You have profit, but you don't have cash. Now, why is this? Because your money is tied up in loans. This is one of the biggest mistakes that lenders make today. They focus entirely on growing their loan book, and they completely forget that businesses actually operate on cash. Cash flow is what keeps the lights on. Cash flow pays for your salaries. Cash flow pays your suppliers. Cash flow allows you to take advantage of opportunities. Cash flow allows your business to survive unexpected challenges. Without cash flow, even profitable businesses can fail. I often tell lenders that cash flow is the oxygen of a business. You can survive without profit for a short period. You cannot survive without cash. The first thing every lender should monitor is the availability of capital. How much money do you have available to lend today? Not next month, not after collections come in, today. You need to know exactly how much capital is available at any given time. Because lending businesses are capital intensive businesses. The second thing you should monitor is future collections. What money is expected to come back into the business? When will it arrive? How reliable are those collection forecasts? Many lenders make decisions based on money that they hope to receive. Successful lenders make decisions based on money they know they will receive. Understanding future collections helps you plan properly. It allows you to deploy capital intelligently rather than emotionally. The third area to monitor is overdue accounts. Overdue accounts, they create uncertainty. Every overdue account places pressure on your future cash flow. The more overdue accounts you have, the less predictable your business will become. That's why collections are so important. Good collections don't just improve profitability, they improve cash flow. And predictable cash flow creates stability. The fourth area is expected expenses. Many lenders know exactly how much money they expect to collect, but they have no idea what expenses are coming. Successful business owners know their numbers. They know what their staff is costing, rent, marketing, bank charges, collection fees, software subscriptions, compliance costs, insurance, everything. Because surprises are the enemy of good cash flow management. One of the biggest dangers in lending is confusing growth with success. I've seen lenders become excited because their loan book is growing rapidly. More customers, more loans, more agreements. But at the same time, their cash flow is deteriorating. Their overdue accounts are increasing. Their collections are slowing down. Their reserves are shrinking. Growth without cash flow can become dangerous. A growing business still needs fuel, and that fuel is cash. This is why successful lenders think differently. Before granting a loan, they ask, how will this impact my cash flow? Will I have sufficient capital available? Will this create pressure on my business? Will this improve or weaken my financial position? They understand that cash flow management is just as important as granting a loan. Now let's talk about one of the most powerful habits that you can develop. Review your cash flow regularly. Not monthly, not quarterly, regularly. Know where your money is. Know where your money is going. Know what money is coming back. Know what risks exist. Know what opportunities exist. The more visibility you have, the better your decisions become. Because cash flow problems rarely happen overnight. They usually develop slowly. And if you're monitoring your business properly, you will spot the warning signs long before they become a crisis. The most successful lenders are not necessarily the ones with the biggest loan books. They are the ones with the strongest control over their cash flow. They know exactly where they stand. Every single day, every week, every month. And because they know their numbers, they can make confident decisions. So my message today is simple. Profit is important, but cash flow is key. Protect your capital. Monitor your collections. Manage your overdue accounts. Plan for your expenses, and never forget that cash flow is the oxygen of your business. Because when cash flow is healthy, your business can grow. When cash flow is weak, even profitable businesses can struggle. Thank you for joining me today, and I'll see you in the next video. Cheers for now.